Hey, thanks for joining us again. We're talking about an introduction to volume analysis. Now, volume analysis as a topic is new in 2021. And so there's a number of chapters that we're talking about. Most of it's going to be centered on the confirmation of trends based on volume. And so we touch on that a little bit about with patterns, with Dow theory and things like that. We're going to go into more detail now with that as well. So looking at the learning objectives, we want to define volume. It's fairly straightforward. Open interest for futures. Define the terms related to volume. We've got 2 pages of terms that you really need to probably print out and make sure you keep a copy of those. Describe how volume provides information on liquidity and also participation. We'll talk about those. And then describe how volume adds perspective to price action. All right, so volume. Volume is basically a trade, which is a price and a number of shares or contracts being traded. We'll talk mainly about this in terms of shares because that's easier to understand. But remember that if we're talking about futures, it'd be number of contracts would be our volume, that type of thing. So trade's made up of a price and the number of units traded, which is obviously the volume. Volume is a validation of price. It's also the measure of liquidity. We'll talk more about liquidity in a moment. Volume analysis attempts to expose the relationship between price trends and volume. Now, we know from Dow that when we have a primary trend, we expect volume to rise as that primary trend is establishing. It's one of the big ways that we can determine whether a reaction is a secondary trend or it's the start of a new primary trend. It's just all based down to volume and what we see volume doing. The price-volume relationship can confirm or contradict price action. So if we don't see volume, we see that there's a secondary reaction, there's not much volume, we get an idea that, hey, this is just a reaction and we're going to wait for volume to participate again. All right, so these are the terms which I was talking about. You need to make sure you print these out. Market volume, that's the standard volume. That's the volume that you and I will see at the bottom of a chart. Usually it relates to the specific market, shares, futures, whatever, that we're looking at the time. The total volume or exchange volume is all the shares or all the contracts traded on a particular exchange. We really don't see that a lot. I don't see that in analysis used very often, but sometimes you'll hear about that. Nevertheless, these things are really going to be easy for examiners to ask questions on, so make sure you do remember these. Total trades is the number of actual transactions that happen. Now remember that for each transaction, that transaction could be 100 shares or it could be 1,000 shares. So the total volume isn't the number of trades, but obviously the total trades is the number of transactions that actually occurred. Tick volume, for each one of those transactions, how many shares were inside that trade? And so that's going to be your tick volume. Open interest, again, only for futures. It's the outstanding contracts. So when we have a futures contract for settlement at some point in the future, we're going to have a buyer and a seller and they write an agreement together, and that is a futures contract. Now, of course, all of that's handled by the exchanges now and the clearing houses, but nevertheless, there is that agreement between a buyer and a seller. And open interest is what's telling us how many contracts are still to be settled before the expiry. So if we get a week out from expiry and we see that there's tens of thousands of contracts to be settled, we know that there's going to be a lot of volume in the next 10 days. So that's where open interest comes in. Upside volume, when we have trades, so let's say we take a tick chart and we've got a trade at $100 and we've got a trade at $100.01, so the market went up. Well, we can say that the number of shares that were traded at 101 cent is counted towards upside volume, because basically the market went up and this was the volume that led to the market going up. And conversely, downside is the same. So we get this measure of upside volume versus downside. Now, if we see that there's a lot more upside volume than downside, then we know that there's pressure pushing the price up rather than pushing it down. And so it can be very important to look at, because sometimes the price maybe it's going up, and then we get one big trade pushing it all down with lots of volume. Well, that tells a different story. So it's a way of looking in behind the prices, if you like, to see what's actually going on. Index volume, it's like exchange volume, and we do see this one a lot more. There's analysis and there's relative cap-weighted analysis that we can do, and that's all based on taking all the shares that are part of an index, so say the Dow 30, and totaling up the volume for all of those 30 stocks, and that becomes the index volume for the day. Dollar volume is the actual dollar value of what was traded. So taking the volume, multiplying it by the trade price, and then adding all of that up, we get our dollar volume. Cap-weighted volume, so this is used more in different calculations. So we look at each security and what their cap weight is, and we adjust their volume appropriately. So we're getting a cap-weighted value there as well. Don't see that used an awful lot, but obviously the author feels that that's one that you need to remember. The float is sometimes called the shares outstanding. It's the actual shares which are available to be traded on the exchange. So again, important number. Average volume is really just a moving average of the volume. So sometimes, because when you've got volume spiking up and down all of the time, it can be really hard to identify trends in volume. So we use an average, maybe 10 or 21 day for a month. We use an average of the volume prices, so it's a lot easier to see trend changes in volume as we go as well. So they're the 2 pages of notes on that. Again, make sure you print them out, really important. I could see a lot of questions on that material. Volume validating price. This is obviously a big one. Again, this is really a recurring theme, as I said. When we've got high volume accompanying a change in price, then we know that there's a lot of confidence. It's validated that, yeah, this price move is significant and we would expect it to continue on. If we were to have a jump in prices, but no corresponding jump in volume, well, that's just telling us that there's not really a lot of conviction. There's not many other people looking on the sidelines, seeing that jump in price and thinking, oh, I want to participate, I want to jump in as well. So there's no consensus in that example. Low volume at a given price casts doubt on the validity of the price. Volume dictates the quality. It's another way of thinking about it, that when there's more volume, then that is a high quality price. And so we can give a lot more store to what that's telling us rather than a price that happens at low volume. Volume and liquidity. So when we have stock that we want to sell, so a large institution may want to start liquidating out of a large position, one of the things that we need to know is there enough liquidity in that market for me to be able to sell? And so that's where we look at volume. We look at the average volume, and a lot of institutions will actually look at that and say, okay, based on the average volume, we don't want to put in more than 2 to 5% of the volume per day. So it's going to take us 6 or 7 days to unwind out of this position. And they keep track of all of that as part of their internal metrics. So they know that, okay, when we get to maybe a distribution phase in the market, we better start lightening our position in this, because it's going to take us a while to get out. We can't wait for a negative death cross on a 250-day moving average. We need to act a little bit earlier. So the liquidity is important, really important. Volume tells us that. It tells us whether there's enough liquidity for us to be able to sell out of our positions. If the volume was low and we were selling and we're putting a large order in at market, then we would see supply way outstrip demand and price would plummet. And so that's why an institution obviously doesn't want to see that happen. They want to slowly get out of their position and try and maintain the price as much as possible. All right, volume and new information. When we get new information, be it in the press, be it as part of a company release, or maybe a change of some sort of fundamental information, we're always going to see some action, even back to the Dow tenants, that the price discounts everything. The price has already factored in all of the news that's out there. But what we can also look at is the volume that goes along with that price action. So for instance, if we have a situation like this, IBM to hire 400 people by the year's end, well, we can see a price change that'll go along with that. But what's the volume? Is there an increase in volume that says, hey, this is significant. There's more people transacting based on this news story than maybe a different news story. So it gives us an idea of how important the market views different types of news. And so, it's always interesting to me because one day we can have a news story which creates a massive spike in the market. And then another day we get a similar news story for a different company and it doesn't have the same effect. So always interesting how that plays out, but nevertheless, volume is the way that we can really tell again. And this again, it's reinforcing what we're talking about, volume confirming price, but just saying it in a different way. If volume rises, it equates to more emphasis being placed on the information that came to market. Volume is also a measure that many investors have different opinions. So again, take this story. There may be people there that look at that and say, that's terrible. They're going to eat into their profit. I'm getting out of IBM. And then a different person may say, hiring 400 people, they must have massive contracts. They must have a lot of work. I'm going to buy IBM. So again, you've got these different opinions. And again, part of this can come down to what's your hold time. Maybe I've held IBM for 4 or 5 years and I'm thinking, look, I've got to start unwinding out of this position. I see this and say, great, there's going to be a lot of people buying IBM right now. I want to liquidate because there's other things I want to invest in. So I'm going to sell into that market. Never assume that one person's right, other person's wrong. Everyone's coming to the market with different reasons of why they're selling, why they're buying at any one point in time. When new information is released, volume reveals the flow of the information. Really, how quickly is that information assimilated into price? So the volume will tell us that, because if you see a spike of volume a day later, then you say, well, gee, it took a long time for that volume to have an effect on price. If you see it immediately, then obviously, which is more and more what's happening with the speed of the internet, etc., we do see these things happening a lot faster. So volume substantiates the importance. Really, that's repeating what we said before. If volume rises, it equates to more emphasis being placed on the information. All right, so you get the idea behind that, how important, information and different events, external events, their importance in price, is seen, but the volume confirms that as well. When traders believe in their investment, they place big trades. Now, this is the example where if I were to say to you, I believe that company XYZ is going to go up and, we should invest. If I was an advisor and I was saying, go and invest in that company, and yet I only put $100 in myself, then the number of shares I put in is really a contradiction to what I said to my recommendation. So if I really had conviction about what I was saying, I would put in thousands of dollars and be investing that way. So that's how it works on the individual. Now, we're not always going to know that on an individual basis, but for the general market, we do know that volume. So if we see volume rising, we do know that there is conviction there and that people are buying. Now, the interesting part to this is obviously if supply dries up, because let's say we all had the same opinion, we all thought that XYZ was going to go up and nobody wanted to sell it, well, then obviously price is going to skyrocket because supply is completely dried up and there's a lot of demand for it. Again, for those reasons we said before, that's unlikely to happen very often. Volume exposing the truth. Again, we talked about institutions and their buying and the need for liquidity. For selling, I should say, and the need for liquidity. The same thing as when they buy. they don't want to put in a large order into market because, if the average was, let's just say 100,000 shares per day, let's say 100 million shares per day, and they come in with an order of 50 million, well, that's going to make a massive impact on price. So they won't put a trade into market like that. Rather, they will buy at market. So they'll look at the bids and the asks that are there, and they will just buy up at the ask, depending on whether it's within the range that they're willing to pay. And then they'll also use things like VWAP, which is the volume weighted average price. We talk a bit more about that, but it's looking at the intraday value and saying, where is the weighted average price? And they want to make sure that they're sitting beneath that or around that price, because it kind of disguises the fact that there's a big institution moving money. If an institution moved money away from VWAP, then VWAP would have a very pronounced rise or fall because of the volume that they're putting into the market. So they'll use tools like that as well. A significant rise is always going to be an indication that there's an institution participating. So, we looked at in the previous session on charting, I think it was, about Facebook, and we had a Facebook at 37 million shares, which was greater than normal in that period. Well, that's really an indication that there's an institution there. They're working and moving in and out, and so that tells us that if the price was going up and the shares were going up, well, there's someone with a lot of conviction sitting behind that as well. So again, always important to be looking at volume. Volume and velocity. So this is now coming back to Charles Dow, and he really interesting. He had two thoughts that he put out as part of his tenets in writings, etc. He believed that high volume indicated a more accurate price. Again, that's reinforcing what we said before, that volume confirms price. But the other thing he also believed was that volume can actually lead price. And this is a little bit of an opposite. We always think about, okay, there's a price change. Does volume support that? Is volume confirming that this is a real legitimate price change? But the other way that Dow looked at this was to say, if the prices were pretty consistent and then there was a large spike in volume, his expectation was that price would then have a pretty significant move following that. And so it's the other way around, almost like the chicken and the egg type example. Which one comes first, price or volume? But that's really what he's saying. So I think that's something to keep in mind, that if you do see a large move in volume, you can expect a large move to follow in a price, either up or down. It's not saying that a large move in volume only means that it goes up. It can go down as well. All right, so that's the introduction to volume analysis. So we're defining volume, basically on a trade basis, and then into a period basis as well. What's the volume for the day? Defining open interest for futures contracts, the terms related, print those 2 pages out, describe how volume provides information on liquidity and participation, covering those, and then how volume adds perspective. So again, that last slide there from Charles Dow, how we get these different perspectives on price action. Yes, volume can confirm price, but there is this nuance there where we can have volume leading price as well. All right, we'll continue on with the next chapter in volume analysis.